Certainly, it's been a busy year for FinCEN, especially with the rollout of the beneficial ownership requirements under the Corporate Transparency Act. They've issued the final rule for beneficial ownership reporting, as well as proposing a rule for accessing and safeguarding the reported data. In addition, there have been several pieces of guidance and requests for comments that have been made in accordance with the rollout of the entire process. These two implemented and also proposed rules reflect two of the three rules that, at a minimum, must be passed under the Corporate Transparency Act. The third of those rules, of course, is the revision to the CDD regulations. Now let's take a look at the beneficial ownership reporting rule. The first thing to keep in mind is that the rule is not directed towards financial institutions in particular. Rather, it's applying to anyone forming or administering any non-personal entity in the U.S. And as a result, the applicability of the rule hinges on whether an entity meets the definition of the term reporting company. So starting next year, any new reporting company will need to comply by reporting their information within 30 days to FinCEN, while existing reporting companies will have 1 year from that date. And furthermore, after an initial report is filed, any changes in the entity will need to be submitted within 30 days. So what is a reporting company? For us in the bank industry, it could be easy to fall into the trap of thinking that reporting company will mean the same thing as legal entity customer, as the definition looks almost the same on the surface. But as we know, when defining a term, regulations often set wide parameters for what's included and then refine those with exemptions, exceptions, and other limitations. And that's certainly what FinCEN has done here. Now looking at the table here, you want to pay attention, of course, to the bolded out items. These are the 7 types of entities not directly mentioned at all in the CDD rule. And with respect to tax-exempt entities, the beneficial ownership reporting rule expands quite a bit upon what the CDD rule had in place. For financial institutions, it's important to understand these differences because during the period between when the reporting rule goes into effect and when the changes to the CDD rule go into effect, there may be pushback from those legal entity customers meeting the definition under the CDD rule, but not meeting the definition under reporting company. And you'll need to ensure your institution's prepared to respond to those circumstances appropriately. The CDD rule had applied a limited exemption to any nonprofit corporation or similar entity that had filed its organizational documents with the appropriate state authority. Now that's almost verbatim from the rule here. Now this has been, from our observation, a common area of confusion for financial institutions. And really the first half of this subsection for the reporting rule is much more specific and clear, while the second half has been somewhat controversial. The tax-exempt entities have details out 3 different categories, and those are, of course, the 501c type entities, as well as 527 entities for political organizations, and of course 4947 such as charitable trust. One that's been somewhat controversial has been the entity assisting a tax-exempt entity subsection here. In the preamble to the reporting rule, FinCEN actually acknowledged that during the proposal process, there had been some comments saying that really this is an unprecedented type of exemption when you compare other countries' registries to what FinCEN is rolling out. In one particular letter, they even went as far as to say that the exemption was the product of a lobbying effort and didn't have any kind of merit-based explanation and could be linked to dark money and politics and things of that nature. Now, we don't bring this up to weigh in on that debate, but rather to bring awareness to the matter. As we all know, bad actors will target any potential vulnerabilities. And down the road, when the changes to the CDD rule do go into effect, that could be an area of increased risk that financial institutions will have to pay attention to, both during the account opening process and thereafter. Large reporting companies really is defined by 3 parameters, and that's employing 20-plus employees in the U.S., having an operating presence, and then having 5 million plus in gross receipts or sales. So now that's going to apply to quite a few businesses out of the gate, and certainly down the road too, as inflation increases the amount of gross receipts. There's no automatic adjustment that will go in place for that parameter, although there may be revisitations to that threshold. Another area, of course, is inactive entities. And this is more of a housekeeping one where initially you could look at it as a increased risk area for, say, shell companies or aged shelf companies where if they have been established pre-2020 and had very little funds flowing in or out of the company, that they would not need to report the rule. But if you look at it, really, it's a pretty restrictive dollar amount over a 12-month span. So as it pertains to the definition of beneficial owner, FinCEN does use a pretty similar construct as a CDD rule as its foundation. However, the definitions of control and equity ownership and interest ownership are much more specific than they are in the CDD rule. But for the sake of brevity, I'll encourage everyone to examine them and note that they significantly expand the definition of controller and equity interest. Instead of identifying just one controller, as is required under the CDD rule, reporting companies must include all individuals that qualify as controllers when reporting to FinCEN. Another area which should be of interest to those listening is the FinCEN identifier, which is essentially going to be a non-public ID number that's going to be assigned to anyone that requested and is granted that, which individuals can request from FinCEN so that they can limit the exposure of confidential information. Essentially, in lieu of putting their name and social and an address, date of birth, all onto each of the forms as required, they'll have a FinCEN identifier reported there. What really remains to be seen here is the eventual downstream impact for financial institutions. Once the access is given, the question now remains, will authorized users be able to view the personal information for any individual that has been given an identifier, or will that be limited so that they only see the identifier? They intend to have several different types of users. And these 5 types, of course, are going to be law enforcement related and also regulatory in nature. But also a key one here, as you can see in item number 3, is financial institutions. So the rule further goes into detail as to why it is that each different type of agency or entity will have access or be given access. Specific to financial institutions is going to only be for complying with CDD and BO rule requirements with consent from the reporting company in exchange for receiving a transcript of that information. For instance, it won't be a database that institutions will be able to query during each and every investigation or enhanced due diligence review. It's going to be something that sort of similar to or comparable to during the mortgage application process when you obtain a copy of an applicant's tax returns through the 4506T form, and they need to provide you consent to be able to obtain that. So there's going to be an increased explicit requirement to have safeguards and security controls in place to safeguard that information. And as part of that, there will be annual audit requirements to certify those security controls and also the acceptable use of the information. With the rule that FinCEN is now rolling out and establishing the database, their target date for having that database established is January 1st, 2024. And as I had mentioned earlier, this is the second out of the 3 rulemakings required by the CTA that pertain to beneficial ownership. And the final pending rulemaking, of course, is that CDD revision. And that rule must be proposed by January 1st, 2025. Given the current state of things, I think we can anticipate a good 3 or 4 years until this finally has a concrete impact on financial institutions on a day-to-day basis. It's wise to continue to pay attention to the guidance that's coming out and the developments with all these different rules and regulations so that you can be prepared to explain differences between the current rules and the rules that apply to all members of the public, as there may be some pushback from customers when there's a discrepancy between the two. There are going to be some differences between those CTA exemptions that will actually pose some increased risk potentially and may want to have incorporated into your program as part of your CDD, EDD approach. But also you'll want to anticipate questions from some of your customers and just continue to pay attention to business developments in this area.